intentional not just to be about mitigation, but also adaptation, which of course plays into sustainable development. The role that we try to play is driving investment on the one hand, but also making sure that every dollar achieves as much as it can. So looking holistically through interventions requiring contributions to multiple SDGs, integrity in the carbon accounting, et cetera. So busy slide, but this is our strategic framework which effectively represents our theory of change. In the top left corner, thinking about how we can raise ambition, and we think about this in different ways in terms of thought leadership and advocacy. This is not our core competency, but we do identify some opportunities where our expertise lends a unique voice. For example, in our work influencing Article 6 and making sure it had strong sustainable development provisions, some of our thought leadership on claims evolution, trying to think about the corporate responsibility, using markets and beyond. Secondly, we develop solutions and assure impact. That's our core. So guidances, tools, methodologies, gold standard for the global goals writ large. And we're also thinking more about enabling environments, making sure that it's not just, here's a very complex standard, please use it. It's thinking about different ways to build capacity locally and make sure that people understand a complex standard and can use it and benefit from it. And then, of course, to perform with excellence. I guess that goes without saying. So when I talked about those new solutions that can be delivered through Gold Standard for the Global Goals, it's really the same core. We're not trying to recreate the wheel. What we're trying to do is create new pathways for impact certification so that both existing kind of claims, we used to have basically a monoculture world of here's carbon neutrality, that's the claim everyone's trying to meet, and here are carbon credits, these are the instruments that you can use to meet it. What we want to do is expand that, including carbon credits, but also portfolio certification, fund certification. We just talked about blended finance in the previous session. How can we apply the same gold standard principles for environmental integrity, safeguards, stakeholder inclusivity to value chains? So companies can make impact within their value chain or in their kind of fuzzy boundary in scope 3. Looking across landscapes, bringing different actors together to deliver impact at scale. And those are meeting different opportunities for what is demanded in terms of claims. In some cases, it's just to meet regulation. The emerging deforestation regulation in the EU can provide new opportunities there. Obviously, net zero targets, beyond value chain mitigation, et cetera. So that's the context. I'm very fortunate to be here with three guys who are going to talk to us about some of their work that meets these, that brings this together, and to ask Sandeep also to respond from a project developer perspective. So let me introduce formally Sandeep Roy, the CEO of VNV Advisory. Vedantha Kumar, who is here representing his role as trustee for the Murmur Fund, which he'll share information about, as well as Ben Broche, who is the associate director for the lab, CPI. I went with the shorter version. Okay. So Vedantha, can I start with you? Can you talk to us about Murmur and what you're trying to achieve, how it fits in with the Beyond Value Chain Mitigation Framework that SBTI has recently come out with?
Yeah, absolutely. And thanks so much for having me here. It's great to be with you all. And also, thank you to many of the people in this room and in the conference who have helped to provide the ideas that led to the formation of Murmur. So I'll say a little bit about it. So Murmur is a soon-to-be-launched platform. We've got some initial backers, but also soon to be formally launched later this year, that helps the arts take action on climate. And we are there to respond to a few problems, one of which is that artistic industries, as we found, want to take action on climate. They often have the moral imperative, and they also have a lot of pressure from within their staff and their other stakeholders. They want to, and there's a huge potential impact here. And we've seen the power of the arts in changing the debate on things like the gay marriage movement in the US or Black Lives Matter, and we can go on. And there's a general recognition that the artistic industries, the creative industries, haven't yet played their full potential when it comes to climate. So Murmur is there to help at a company-wide level, an industry-wide level, to take action on climate. And why? Because it's incredibly valuable to have one artist here or one artist there to take action on climate. It's much more powerful, we think, if an entire industry that supports all of these artists is literate and is able and fluent in the language of climate, and enables the whole industry as a system to play its part in the climate fight. So Murmur kind of does three things. It's a re-grantor, it's a charity, but it does three things to help the industry. The one first is the basics. So we help companies that are often quite small or medium-sized. They're newer to the climate world in terms of measuring their emissions and so on. And we help them to do the basics: measure emissions, disclose them, set a science-based target, short-term, interim targets, and have a plan to achieve them, and so on, governance around that. So we help with the basics. The other thing we do is we have what's called a strategic climate fund. And this is probably the most interesting thing to this conference, and I'll talk a bit more about it in a second. But essentially, it builds on the WWF blueprint, which was, I think, an amazing document put out several years ago, which invited companies to pursue an alternative to traditional offsetting and to place a carbon price on their unabated emissions, and with that money that's then raised, to invest it in the most impactful things that will contribute towards global net zero. And that's basically the approach that we've tried to take, and we have taken so far with our initial companies. So we're putting a price so far of £50 a tonne. That's what the companies have signed up to. And then finally, the companies benefit. We provide a way for companies to benefit through the association of Murmur, peer-to-peer networking, but also having the Murmur label or badge as something that they can say, look, we are doing the most we can on climate. And I'll come to that as well a little bit later on. So the strategic climate funds. So if you think about Murmur, it's pulled together this funding from these creative industries. Say it's a record label, it's measured its emissions, it's got X number of tons, it's playing at this point in time, it's applied a £50 a tonne price. That money has then gone to Murmur. How does Murmur spend it? So there are three buckets that we've identified to use. One is about helping the creative industries decarbonize. And this is important because they often have hard-to-abate emissions. And climate is a collective action problem, fundamentally. And if you're working in the music industry and you've got vinyl processing, that's really, really hard to decarbonize, or shipping in the arts industry, or flights is endemic throughout the creative industries. So collective action is needed, and so we help fund initiatives that will help the industry as a whole decarbonize, where they'll benefit from those coordination and collective gains. The other is communications. The most powerful thing that obviously creative industries can do is to speak about climate to their huge audiences. But to do that, climate's so nuanced, so complex. So Murmur provides grants to organizations that will train artists and others in the industry so that they are more literate and fluent on the issues. And then finally, what do they talk about? It's not good enough just to say, I can speak about climate. What are you going to put your voice towards? And we were just talking earlier, Ben was talking about Rihanna, who's put her voice to the Bridgetown initiative to try and reform public finance globally. I mean, that's huge and that's pretty awesome. Like, when does that ever happen? And he was saying, I mean, there's no celeb who's talked about public finance before, let's be honest. So that's pretty cool. And what Murmur will invest in its third bucket is our initiatives that try and create systemic change on climate. And actually, some of our first grants have gone towards organizations that work on systemic climate litigation or legal action. But other things could be campaigns or advocacy, and so on. And that's very similar to what philanthropies do, and I'll talk about that in a second. So where is this relevant to, part of this is about beyond value chain mitigation. And I think the things that maybe Murmur does differently, and it's not necessarily right, I think it's exactly what you said, Sarah, it's an alternative approach that we want to try, additional to everything else that's going on. One is beyond offsetting. It's very clear that if you're investing in Murmur, as a business, you are not getting a ton for ton equivalence in what you're getting out on the other side. So you are not ever going to be able to say you're carbon neutral or anything like that. So it's very much moving beyond the offsetting paradigm here and moving towards a contribution framework. And Owen at Gold Standard often talks about contribution towards global net zero. I think that's how we locate Murmur. The other is beyond net zero. And what I mean by this is, like 4 or 5 years ago, the norm for a company was to be, or a high bar was to be a company that had a net zero target by 2050. That's evolved a lot over the last few years. And I think what we're seeing, especially in the global north, that for companies that you probably need to go beyond that. And for some industries, it will be incredibly difficult. For heavy industries, if you're steel, net zero 2050 is pretty ambitious. If you're in the music or arts, maybe you can go further. And these companies want to go further. And so they're saying, we're going to get to net zero, we're going to have short-term targets, all that stuff, but we want to do more. And then finally is this interesting thing about what the companies invest in. So traditionally, those companies with their money that based on the unabated emissions might have spent that on traditional carbon credits, on forestry projects, cook stoves, and so on, which have a really useful role. And I work at SIF. I oversee, so SIF's the Climate Foundation. I oversee our carbon markets portfolio there. We support a lot of work around trying to make the carbon credit work, carbon markets work in that way. But this is trying a different approach, more towards, I guess, what philanthropy has done in the past, looking at what is something that's maybe a little bit where you can't quantify the impact, but could have systemic effects if it works. And I think it's also playing on the question of what is the most valuable thing that these industries can do. And for if you're in the music industry, the most impactful thing you can do probably isn't a cook stove project. It probably is finding a way to reach out to your audiences. So I'll finish off about there. I think I'm roughly on time, right? Great. I guess I have maybe a question to finish off with, and I'm really looking forward to the others. But the question is, what is the most robust way in which organizations like Murmur or this approach can operate? The approach we've taken is to have Murmur as it's an independent entity. It's independent from the businesses that support it. Its governance is going to be really strong, and we've already got people like Chris Stark, the head of the Committee on Climate Change, on the board. So really, really good governance to then work out what's the most effective grants we can give. What we've started to discuss, and we've started having early discussions with the Gold Standard team, is there a way that you can provide some kind of methodology that gives companies extra assurance, like they have with carbon credits? You have a form of assurance that says this is probably a good project and this is probably a not so good project. Is there a similar way of doing that for things that are a little bit different, like this, where companies are investing in strategic philanthropy or other forms of mitigation or collective action that helps all of them decarbonize but doesn't necessarily, you can't quantify immediately? So that's a question I'd leave off with. Murmur is going to be soon to be launched. If you're interested in finding out more or we want to get involved, take part, please let me know, and love to speak afterwards. But thanks again, and I'll pass it over to who's next.
I'll pose a question.
Okay.
But I actually, to reflect on your point, Vedantha, I know that's something that we've heard from some project developers, some concerns that we don't want to go back to the world of just I randomly decide what I'm going to contribute to, at what level, and what is it accomplishing. You're absolutely right that it's not as clear. Some of the impact isn't always as easily quantifiable, but some of it certainly will be. But we should explore that together and see what we can actually verify, so that there's a credible claim at the end of the day. So great, thanks for that. Ben, could you give us an overview of the Climate Finance Lab, your role in project preparation, how it can help projects get to bankability, and what that might mean for project developers in the gold standard community?
Sure, happy to. And thanks, Sarah. So before answering that question, just want to kind of set the context a little bit. So I work at Climate Policy Initiative, or CPI, for those of you who may or may not know. CPI is a global analysis and advisory organization that works with governments, corporates, and financial institutions to drive economic growth while addressing climate change, is our mission. one of the pieces of work that we do outside of the lab is track climate investment trends in our data analysis team. And what we've seen is climate finance just about doubling over the last decade, which is good news, but I don't think it comes as any surprise to anyone in the room that not nearly enough investment is going into the climate space, and this is especially true in emerging markets, which are the most desperately in need of this investment. We need to see something in the order of 5 to 15 trillion a year if we're going to meet net zero targets, and we're definitely not seeing that now. Most of this funding will have to come from the private sector. We operate within the lab on a very simple thesis, which is that in order to unlock that private capital and address the persistent, real and perceived risks that are preventing investment from going into high-quality emerging market climate projects, you have to leverage impact capital and donor capital very effectively in order to do that. So in the last session, I know you heard quite a bit about blended finance, and that's good framing, I think, for this discussion, at least in the context of the lab, but probably for all of us as we think about new ways to bring capital into the space. And the lab is basically an investor network of private sector investors, commercial banks, institutional investors, and others, governments, and development finance institutions and some philanthropies. And the idea behind this is to basically function like an investor network and accelerator, identifying the best ideas that are out there for new funds in the blended finance space and innovative financial approaches, many of which are leveraging the voluntary carbon market, some of which are not. But one of the things I think that might be interesting to talk a little bit more about for the project developers and others in the room are ways to be thinking about revenue streams and approaches that might be outside of the carbon markets, but also using carbon finance as another potential revenue stream. So we identify these great ideas. We work with our investor network to select a cohort of a few each year that go through a really intensive process where we look at the market context, we help them put together a proper capital stack, we help them establish the partnerships necessary, look at the pipeline, look at basically all of the risks that might go into a series of climate-relevant projects in emerging markets, and help address that through various mitigation tactics, whether that's directly within the capital stack or whether it's in other ways, looking at political risk, looking at credit risk. These are often the things that prevent private investment from flowing. So once we've done that, we then help them through our network to move to market. So we provide about a year and a half of support overall. We've developed 62 different funds and innovative finance vehicles through the lab over the last 8 years, which have collectively mobilized about $3.6 billion in investment. We're really proud of the fact that almost half of that is coming in the form of institutional or commercial capital. So this is, of course, the type of capital that we need to be flowing into emerging market climate projects. But unfortunately, what we see most often is many of these projects being propped up by philanthropic capital or concessional capital, which is fine, but it's inherently unsustainable. The money is just not out there to bring us anywhere near where the NDCs have us at or net zero pathways. So I just want to highlight maybe a couple of approaches within our network that I think are pretty interesting, and maybe lay out the pathway for that question around what opportunities are there for project developers and what are we seeing out there. While it's growing rapidly and is an incredibly necessary tool in the transition to a net zero and ultimately climate resilient economy, the voluntary carbon market is very volatile and unpredictable. And I think this is one of the things that's ultimately driving outside of concerns around just integrity and stability, which of course Gold Standard and others are working very, very hard to address. We're at probably a real inflection point in this market. But what we tend to look for in the lab, and what our network of both impact capital providers and often private investors that we're speaking to are looking at, are ways to mitigate this risk through ensuring that there are financial flows outside of those that rely on carbon finance alone. So one of the nature-based solutions instruments that we have helped develop through the lab, that's being led by Conservation International and a number of partners, is called RISCO. And RISCO is interesting because it looks to restore mangroves in crucial carbon sinks in coastal ecosystems around the world, with an initial pilot in several regions in Southeast Asia. And they're valuing the resilience benefits of the mangroves and basically creating revenue streams through cost savings on reinsurance for high-value coastal assets, and that's their primary revenue stream. They have a secondary revenue stream around blue carbon finance, which is, of course, a very rapidly growing space within the carbon markets, as we're seeing a lot of leading corporates and tech companies in the climate space involved in the Blue Carbon Buyers Alliance and others that are really acting rapidly in this space. So there's sort of those two twin revenue streams, and they're relying on carbon finance for a piece of this, but they're also operating a bankable instrument on their own. We've also been working with a project developer called Cross Boundary, putting together something called the Fund for Nature, which is a debt fund that's providing sort of standard debt to carbon project developers for nature-based solutions in emerging markets, high integrity only, and via a universal and totally transparent offtake agreement, in an effort to keep the revenue streams local within the communities, and of course adhere to the biodiversity and impact standards there locally as well. But the idea behind this is the majority of their funding is coming in the form of debt finance and capital that's being returned to the fund. Of course, it relies on carbon finance as well, because the projects have to have off-takers. But it's an effort to basically get around some of these risk mitigation issues that are sort of inherent within the sector at this point. So yeah, I would just encourage the project developers that are out there to look at bankability outside of just carbon finance alone. And if you're interested in the lab and potentially being an applicant, we're going to be opening another call for proposals for innovative finance instruments that are addressing key barriers in emerging markets this September. We've also recently launched a brand new initiative called the Catalytic Climate Finance Facility with Convergence. I think many of you heard from Leah Peterson, who was on the last panel. They're a key partner of ours, and the Catalytic Climate Finance Facility is a very similar approach to the lab, but we're actually offering seed capital to blended finance practitioners and innovators, in addition to the technical support and network access that you get through the lab. So just a quick shout out to that. I don't know if Leah's probably somewhere out there in the audience in the back. Sarah,
Perfect.
Over to you. Hopefully that was relatively on time.
Perfect. Thank you. I'm really encouraged to hear you think about new revenue streams for developers, diversifying that, because I think it goes underappreciated that in carbon markets traditionally, project developers take all of that risk up front with the hopes of selling carbon credits at the end of the day. So new ways to de-risk that development is, hugely welcome. Okay, Sandeep, tell me what you think. What is VNV doing? I know that you have a big portfolio of high impact projects within the voluntary carbon market, but if you could share with us also how you're thinking about new instruments, Article 6, potentially Scope 3, where do you see the biggest opportunities?
Thanks, Sarah. I think the big opportunity, and I know it's often underrated or probably overused in this conference a bit, is blended finance, but that's exactly what we need, I think. So before I get into how the different market mechanisms could probably get into financing, I think there is still a role for philanthropy in this space, but more as a revolving capital rather than just a donor-based capital. For example, I would still lean on philanthropy for model development, for example, for DMRV tools and stuff like that. I think that's a huge catalytic thing that's missing in this entire piece. Project developers to use tools that can be made via funding through philanthropies. I think that could be one. Number two, we have seen things like partial risk guarantees and things like that. Philanthropy could play a big part in that as well, because that can layer finance, de-risk the entire capital. As you say, a lot of project development is very, very capital intensive. And this, I talk about all different kinds of projects. I mean, I think we get stuck a little bit on carbon markets with either cook stoves or renewables, but the carbon market is a lot more than that. A lot more than that. So every different type of project will have different models that work. I think in cook stoves, debt instruments is a good way to work. Instead of pre-financing on a discount or price, for example, which is most of what all of us did earlier. But right now we don't. So there are instruments that can, I think different kinds of players, and I do believe donor-based funding is still important, but you need to get the capital back and redeploy again and again and again. And that, for me, is a very effective way for philanthropy to help institutional investors or corporate investors invest into carbon projects. So that's number one. Number two is within the project level, there could be various financing layers as well, which can actually go towards sustaining this project. Again, moving out of the cook stove mindset, let's say a nature-based project. You're not going to be there forever. I mean, for us, we don't. We contract only for, say, 10, 15 max. We're out. And we should be, because by then, if those same communities cannot access carbon finance, then the carbon markets have failed them, in my opinion. So now the thing is to empower these communities to get their own carbon, because you want the money where it's needed instead of being here. This is not where you need the money. So there you need to build inbuilt financial instruments, financial inclusion instruments, let me rephrase. Because a lot of communities that you would work with do not have access to any mainstream sort of finance. If carbon finance can go towards empowering them to then access that 15 years later, first thing, credit history. There is non-existent credit history in most of the Global South communities. If you can use carbon revenue and other forms of philanthropic capital to build that, I think that's what a carbon project should be doing. It's not just about this ton of CO2 at the end of the day. You want to leave communities after 15 years saying, guys, you're on your own. If you're an agroforestry project, you have to work with value chain building. Beyond value chain is a concept, great. But what do? You build that entire thing. For example, in one of our projects, they plant mango trees. Great. You plant the mango trees. You pay them up front, pay the mango trees. And said, okay, but what are you going to sell the mango at? And then we said, guys, if we use the carbon revenue instead of, and we don't believe in direct cash benefit carbon revenue generation. He said, no, I'm not going to give you this $10. What I'm going to do is I'm going to pool it in a form of federation, which will then build your federation's carbon credit history, which can then access mainstream finance. It could be finance at half the interest rates for all and we could pay half their interest rates. But we built a mango processing center, which makes mango into pulp. And pulp sells for almost 60% more than the mango itself. And there you have a general market, and that's the value you want to leave. And a federation selling pulp now brings in a group kind of a livelihood activity, which is then your other financing mechanism and de-risking the project from things like permanence. I mean, that's what they ask, what if they cut off the tree? I said, why would they cut off the tree? You tell me, So there are various ways to layer finance, both at the upstream level, which is where I think philanthropy needs to play a role, with financial institutional, financial funds, corporates, all of them need to come together on that. And on the project side, this is something that has to be looked at. There is no one-size-fits-all here. And then, of course, and then that's how the carbon market, of course, will, I think, figure itself out. And then, that's on the voluntary space. Obviously, on the compliance space, you will have what can the compliance space help with? I think the compliance space can help standardize pricing, in my opinion. I don't think we need standardized pricing for all kinds of projects. Like the projects I'm mentioning right now, you don't need standardized pricing, but probably you cannot get standardized pricing because you'll be going against the whole concept of financial additionality then, in my opinion. Because every project has a IRR threshold, which is quite different. And I do not believe a standardized pricing does justice to that. CapExes are different, capital cost raising is different, it's completely different. But compliance market gets you standardized pricing, and I think there's a huge role to play because, like I said, the carbon markets is not just about one or two types of technologies. If you're talking about a government-based subsidy on EVs, for example, Article 6, amazing thing to do because you need standardized pricing, you need pricing, some kind of understanding of the structures and so on and so forth. So there, I think compliance markets can play a big part. In technology transfer, the whole global north to south technology transfer that we keep talking about and does not really happen. I think carbon markets on the compliance side can do a lot with it. And there you could have different kinds of voluntary and compliance interacting with each other, of course, as well. But I think we should look at compliance for more technology transfer, understanding mitigation costs. It's a super important thing in the emerging world. People do not understand what the mitigation cost could be for different technologies. That's where VCM plays a massive role. And actually, I know governments and VCM are a bit in a thing because of the whole Article 6 dialogue happening. But in my opinion, whichever governments I work with welcome the whole idea that, okay, these technologies, this is the mitigation cost. And so that is where I think price discovery on mitigation is going to be very, very important. And that's where I think these two can interact. And to end with, I think this is something I just want to share, and this is something that we've been working on, is to actually decouple or make a project into parts. Not everybody's looking out for the same thing in one project. In a project, you have a mitigation outcome, you have a health outcome, you have a gender outcome, you have various outcomes. What if different actors need different outcomes? These are all certified by one standard. And that, I think, could play a part because not everybody has a budget for a 20 euro carbon offset today. But it's not 20 euros just because of the mitigation. It's because of a lot of other things. So I think there is a play in that as well, in actually breaking down an entire investment and why you need the money, and having different actors participate in the same project. I think that day is coming and will come very soon. So I'll end with that. Thanks, Sarah.
That's brilliant. Thank you so much, Sandeep. I mean, a couple reflections. I love that you're talking about you're not just building carbon market access, but access to broader financial markets, which is perhaps one of the biggest SDGs that you can deliver against. Also that one size doesn't fit all. Everything's moving to blended approaches, or ought to be, or it can have much more impact. There's a role for philanthropy. We see that in the blended finance vehicle, the Subnational Climate Finance Initiative, where there's some philanthropic capital for the technical assistance facility. So yeah, I think that's all really interesting. Can I ask if the panel have any reflections on how Gold Standard could play a stronger role on the project developer side, or in supporting, Murmur, CPI, or if you have any questions for one another. Yeah, Sandeep, I know you're known for telling it straight, so tell us what we can do to help.
No, I think you guys are doing a great job. But yeah, I think this whole impact monitoring thing, I mean, you guys are already working on it, I know that. But that, if we can expedite that a bit, and involve a lot of corporates in those discussions and financial investors, I think there's no point making something a product if there's nobody to buy it. So I would imagine that is one way to really, and again, I think you are right, the claims are going to change. And I think the world is going to move towards that side sooner or later. I mean, you don't have to make the carbon neutral claim for everything that you do. But like Sarah said, we are all worried about just philanthropy. Back in the day, CEO plants 2 trees and says, I'm the best, most environment friendly CEO in the world. So that's something you want to avoid. It should be commensurate to something, not necessarily compensating. But I think if some work goes on that, I think it's super important. I think what Gold Standard can do is, one, give us very clear metrics on impact monitoring. I think most impacts can be quantified. Most. I mean, there would be obviously something here and there that can't be, which is fair. but I think 99% can be quantified. And that for us, I think then becomes a financial structure to work with, so.
Yeah, happy to go next. I totally agree with the need for, I guess, if we were to all take our head above the frame of just carbon ton accounting, we solve so many problems that have plagued the carbon market. And if there's alternative forms of measurement for alternative forms of finance or impact that an organization like Gold Standard or others can bring rigor to, exactly what Sandeep was saying, so that people aren't just making it up, that would be incredibly powerful. I think the other thing is, on the demand side, is having organizations like Gold Standard and others providing first a methodology for, and I know SBTI are working on this, VCMI are working on this, lots of big institutions are working on this, but all helping to both develop and then communicate methodologies for companies to do beyond value chain mitigation. What does it look like? I mean, take the WWF blueprint. What is the price, the carbon price that companies should really be using? We're using £50 a ton because we looked across various different factors and metrics, and that's what we came to. But I'd love it if that was one that was shared across different countries, maybe, well, different companies across Europe. A different price will probably apply to the companies operating in different geographies. But so that would be another. And then the third is just, we talk a lot about I hear a lot of talk about the need to move towards like a contribution framework. I think just inviting more companies to take that approach would be fantastic. Because actually, one of the biggest things about Murmur, like setting aside you may have different views about what the money should go on and so on, but the amount of money it's aiming to generate is far larger than through traditional offsetting. If you take an offset price of maybe, they vary hugely, but let's say it's $10 a ton, $20 a ton. Well, that's obviously dwarfed by £50 a ton, and I know that's not going to apply to every company. But there's also ways we might be able to just generate more finance from this model.
Great.
Not a whole lot to add to what Sandeep and Vedantha just said. Fully agree with everything. I think speed and scale are two very critical things where Gold Standard has a key role to play, and I would highlight the need to fast track high quality methodologies and high quality carbon projects to market. I know you are all working very, very hard on that, but just from the perspective of sitting on the other side, it's having more high quality flavors that are all reflecting the various benefits that each of them possess. A ton of carbon is not just a ton of carbon. These are not projects that exist in a vacuum. There are massive benefits or potential risks and downsides to people and to vulnerable communities on the other side of that. So obviously VCMI and others are working alongside yourselves and Vihara and others in the space to ensure that these benefits are brought out and these risks are addressed, but continuing that work. And I would say to your point, Vedantha, being a voice and a beacon to buyers in the space, to corporates, I think this is absolutely key to for them to understand this space, to scale up their investments in the space, their commitments there, as well as large financial institutions that might be engaged in this and looking to you for guidance. We're about to kick off a piece of work looking at various ways that corporates can, through their balance sheets and through other ways of raising capital, better align and deploy climate finance into the space as actors themselves outside of just the voluntary carbon markets, but within that as well. So they will also be looking to you. So continue to be that beacon of guidance and ambition to those actors and to all of us who are working in the space.
Great, thanks. Well, we take all of that on board. We are definitely looking forward, Vedantha, as you know, to pursuing the beyond value chain mitigation, how to make that operational, how to make it clear, not just on what should the carbon fee be, but then how do I think about what I reinvest in my own value chain versus what is more effective beyond it. We're working absolutely on being able to quantify SDG impacts in a clear, consistent, standardized way. We'll actually see later today a preview of our SDG tool, which has been digitized, and will provide some new opportunities there. And yeah, we'll also be talking about that mainstreaming of contribution frameworks, but making sure that's still happening in a credible way, where it's not just an arbitrary donation that we hope achieve something good, but let's cross our fingers and see. So all very clear. Thanks so much for that. Now I'd love to turn it over to the audience. We have about 15 minutes for questions if you have them. So yeah, we have some mics roaming. Any questions for the panel? I see one down here in the front. Any others so we can send a mic to? Over here as well. And if you could introduce yourself briefly and the organization you represent.
Okay, thank you. I'm Arthur for Global Forest Bond from Brazil. I would like to ask, especially Ben, what in your experience has been the benefit of bringing financial instruments that are settled in the financial world and being used for other contracts or tradings to the contracts or trades to the environmental carbon credits and other other nature-related offsets, and how this can increase legal certainty and make private investors more keen to try these new areas. And what's the role of legal certainty in contracts on this space?
Go ahead, why don't you?
I would hesitate to answer that in full because I think I would probably I'm not going to put myself in the role of an investor in the space, but I would say overall, private capital is looking for stability and certainty to the extent possible, especially international capital that might be investing in a place like Brazil. You may know that we have a lab program operating in Brazil and a fantastic team working there. We work a lot with Vendessa, with private investors there, with many of the value chain companies there as well. So I mean, these tools, once adopted and as they become sort of more standard within the industry, and as we start to see the carbon finance just scaling overall, private investors are looking to those market signals to have certainty and to have a stronger perception of risk mitigation within that. So, I can't speak to it in detail because I'm not in their shoes, but I would say that those pieces, as well as the other certifications that we're seeing, and just broader growth in the market as we start to see these things scale up and become more standard, it's going to be positive for bringing in that private investment. But again, I mean, you need typically some kind of impact capital sitting on the sidelines. I mean, you mentioned the Subnational Climate Fund, which was another initiative that came out of the lab. We've seen the value of technical assistance facilities overall. So having some kind of impact capital that is focused on the ground, on project preparation, on verification, on monitoring and evaluation is really important to ultimately ensure that you can crowd in that private capital.
Any other hands come up so we can send a mic? But
yeah,
Bernardo,
Bernardo from Namene Solar. My question is around, Gold Standard has done a very innovative role at trying to quantify and develop methodologies for different SDG aspects, and even a water access methodology. And my question is, what are the lessons learned? Because those haven't really taken up, no, by demand, no, and whether times have changed and there is more interest from financiers and corporates to actually recognize that there's value in reduction of black carbon, dailies, gender, and all the other methodologies that have required quite a bit of effort and time, but there hasn't been translated into the market-driven mechanisms for financing these actions, no? And some of them are part of the carbon component of projects, but some of them might not be, no? And many projects are doing a lot of development. So the question is, do you think things are turning? Do you see a possibility of simplifying some of those methodologies so that are easily digested by private or blended finance to accelerate impact?
Thanks, Bernardo. I mean, this goes to Sandeep's point about not just building something and understanding where the demand's going to come from. So I think a couple of things. So I think certain investors, corporate and otherwise, have become more interested in quantified verified impact beyond carbon, what we have called co-benefits. Will those be a market-based mechanism in their own right, a tradable asset that is fungible and has liquidity? I don't see that in the near term. I don't think we do. I think there absolutely is an opportunity to both deepen our SDG tool, which I referenced and we'll see a preview of later, perhaps with looking at a simplified form of the A-Daily methodology or other ways to assess gender impact, for example, because we have a gender responsive framework. So I think, yes, we need to deepen and standardize SDG impacts, and I think those will, in some cases, make the carbon credit more valuable. Certainly as investors and off-takers, buyers become more sophisticated and want them to accomplish more with their carbon liability, let's say. But also in impact statements for various mechanisms, so for bonds, for blended finance vehicles, impact equity investment. So I think yes to all of what you said. I think there's a big opportunity there. Yeah, please, Sandeep.
Just when you say simplify methodologies, I'm not a big fan of that, though. I think it's not our job to educate the financial investor on the work that we do. They need to understand this, right? So let's not simplify it for the sake of getting finance, because I think then is again the question of integrity out there, which is going to come up. So what's important to the financial investor? Is it something easy to understand, or you believe that this process has been followed? So I would rather not get too carried away with people in the financial world not understanding what carbon methodologies do. Carbon methodologies should be robust, should not be that simple. I mean, it could be simple to deploy, but I don't think we should be getting caught up in the whole let's simplify it because they don't understand it. I don't know. I don't think you were coming from that, but I'm just making sure that that's something that's super important.
It's really important, Sandeep. I agree that we can't water down carbon methodologies. We must go in the other direction, if anything. I suspect Bernardo was referring more to the A-Dailies, like the quantifying, those type of SDG, really rigorous and onerous, expensive SDG assessments that could be, for reporting purposes, when you're not trading an asset, could be simplified. Fair representation? Okay, thanks. Any other questions from the audience? If not, we can take an extra 5 minutes for lunch, which I think is welcome. So thank you very much, Ben, Sandeep, Vedantha. Please welcome me.